Ladies and gentlemen, welcome back to another episode of the Economic Stand-Up Comedy Hour, also known as Boss Economics World. Today, we're going to break down what's been happening over in Europe's economic madhouse, you know, the one run by the European Central Bank, ECB. Buckle up, because we're about to dive into a cocktail of mismanagement, misguided policies, and missed opportunities that have brought Europe to yet another recession teeter-totter. Sounds familiar? You're thinking, oh great, more high-flying economists playing hot potato with interest rates. And you would absolutely be right. So, what's the buzz in the Eurozone? The ECB is engaged in one heck of a debate: should they cut interest rates lower to boost economic activity, or will doing so make as much sense as mopping the floor with the water running? Right now, we're seeing camps within the ECB split wide open, and neither camp really seems to have the magic bullet. To give you the quick rundown, inflation, yes, that ticking time bomb that seemed unstoppable a year ago, is mostly under control now. Hooray, right? Wrong. A tamed inflation monster doesn't mean that everything is peachy in Europe. While inflation's curbed, the economy hasn't been perked up in the least. If anything, it's looking like a zombie version of itself. Policymakers are now scratching their heads and rubbing their temples over whether rate cuts hold the key to rekindling some economic life or if they're just about flinging spaghetti at the wall, hoping something sticks. You've got guys like Fabio Panetta, governor of the Italian central bank, clamoring for fast and furious rate cuts to give this Frankenstein's monster of an economy the jolt it desperately needs. His argument? The real economy, that stuff like households buying things, workers having jobs, is in the gutter, and unless spending picks up, there's a risk that inflation could drop too low. That's right, after battling runaway inflation, the ECB is now paranoid about the danger of having too little of it. But not everyone is drinking that stimulant Kool-Aid. Isabel Schnabel, one of the more hawkish, cautious or skeptical, voices on the ECB board, sees things differently. Her argument? Some of Europe's problems aren't things you can fix by tinkering with the cost of borrowing. High energy costs, a shortage of skilled workers, terrible demographic trends, you get the idea, are like clogged arteries in the Eurozone economy. No matter how low you send interest rates, you can't make blood, or investment, flow if you've got fundamental, structural problems. Here's the real kicker: where do Europe's chronic economic issues come from? Are they cyclical or structural? Or is it both? Amid this debate, we've got economists slicing the problem into tiny pieces. Holger Schmieding, for one, says it's a mixture of both. Basically, Europe's economy runs in these sluggish cycles, cyclical, but it also has cancer in the form of long-term structural issues like weak productivity and an outdated workforce. The ECB can try playing doctor by lowering interest rates, but it's like treating a serious disease with a band-aid. First off, the cyclical side. What's cyclical? Think of it like the roller coaster ups and downs that economies naturally go through. What goes up will eventually come down. Sure, ECB rate cuts can ease those bumps right now by making borrowing cheaper and pulling some demand forward. They can make it easier for people to afford homes, businesses to invest in new projects, and consumers to buy that extra smartphone or Tesla. In theory, cheap borrowing encourages people and companies to stop hoarding cash and spend. Now, on to the bigger problem, these deep-rooted structural issues that no ECB rate cut can fully address. The Eurozone's demographics are a time bomb. Populations are aging, skilled workers are scarce, and productivity gains are nowhere to be found. Couple this with the glaring issue of Germany, the usual engine of Europe, facing its second year of economic contraction. The vaunted German manufacturing base is sputtering like an old diesel engine, choking on the smoke of stalled global trade and higher energy costs. Speaking of excess energy costs, the US and Russia aren't helping matters either. Thanks to Donald Trump's trade tantrums, remember those tariffs, and the ongoing Russia-Ukraine war, energy prices are astronomical. Now, if you thought wage growth was the key to boosting household spending, try doing that alongside skyrocketing energy bills. But wait, there's more. Even if people wanted to spend a bit more, poor investment sentiment, exceptionally high costs of production, and uncertainty all around will kill risk-taking faster than you can say, foreclosure. Let's examine just how rate cuts are supposed to work and why they might not be all they're cracked up to be. Tin hat warning, though, this might get a bit technical. The ECB's bread and butter, so to speak, involves lowering their deposit rate. That's basically the rate at which banks can stash their money with the ECB, mostly overnight. When they cut this number, it's like saying to banks, hey, just lend this money out, you'll make more doing that than parking it here. Cheaper loans should, again, in theory, give businesses the courage to invest and consumers the ability to splurge a little. But here's the thing, the economy doesn't live in a vacuum. With Europe's consumer spending barely a whisper and global trade slapped left and right by geopolitical messes, offering cheaper loans isn't going to magically produce a growth-based economy. Companies aren't putting their money into new plants or hiring armies of workers because at every turn, they're met with uncertainty, tax policies might change, inflation could come back, trade tariffs might rise again, or any number of left-field disasters could emerge. A lot of Europe's corporate balance sheets have improved, sure, but that war chest isn't being released. A fortress of cash is being sat upon by firms more risk-averse than ever before. Take Germany again, for instance. Investment has been frozen solid. German factories have been trying to diversify away from reliance on Chinese demand, but their windows of opportunity are shrinking faster than the summits of the Alps during global warming. When your primary export market is hurting, you're naturally going to think twice before pumping euros into new investments. Meanwhile, home builders and other crucial sectors don't see the point in chasing after already thin profit margins. Low rates simply don't matter when administrative bottlenecks and slow-pace reforms in bureaucracies leave investment prospects looking dim. Households too, now carrying ever higher energy bills, a slowdown in wage growth, and in some cases, even job losses, are not exactly jumping at the latest mortgage deals. Let's be frank. If the ECB goes gung-ho and blasts interest rates too low, it's not just ineffective, it could become downright dangerous. As the more cautious voices in the ECB argue, Isabel Schnabel being one, overcutting rates may use up their policy ammunition too quickly. Imagine unlocking the doors to the ECB's rate reduction artillery and firing every shell in an empty, desolate battlefield. What do you do next when an actual emergency hits? Enter the potential economic black swans, the unplanned-for crises that no central banker can foresee but will keep everyone's anxiety at DEFCON level 3. There's always Ukraine teetering on the brink of catastrophe, unpredictable Middle Eastern tensions, or perhaps a surprise recession on the back of new global trade wars. You have to keep something in your toolbox, don't you? If the ECB empties all its bullets cutting rates too aggressively, they'll have little left to respond to real problems down the line. Catherine Nice at PGM Fixed Income gets it. She's waving the warning flag. Rate cuts leak across the system, sure, but they won't solve underlying questions of productivity, skills shortages, and long-term growth prospects. Europe needs more than monetary relief. It needs structural reforms and, crucially, fiscal coordination. But who will bell the cat? These governments aren't exactly renowned for their stellar coordination or ability to pass timely, radical reforms. What Europe desperately needs to stave off a further downward spiral is a serious shot of confidence in governance, structural reform, and ease of doing business innovation, not just loose change from rate cuts. Alas, political landscape shifts are slower than a crocodile digesting Thanksgiving dinner. Now what can we predict moving forward? Will the ECB continue with this sluggish easing dance, or will policymakers make a bolder decision? Will they realize that rate cuts alone can only prop you up so far before structural weaknesses outweigh temporary boosts in aggregate demand? The financial markets predict a far more aggressive cutting campaign, markets pricing in a deposit rate falling a quarter point below neutral, in hopes that this will be the net to catch the fragile economy. Will borrowing costs finally hit 2% and push businesses into the invest or die mentality? Maybe. Unfortunately, the true story lies in how governments complement the ECB's efforts with actual fiscal policy, whether they stimulate with targeted spending or buckle up for austerity to death. We're looking at you, Germany. At least some level heads like Bundesbank's President Joachim Nagel are making it clear, inflation targets aren't bulletproofed by rate cuts alone. Nagel makes an especially important point at the heart of the debate: just because inflation is below 2% doesn't mean you carve out huge swaths of policy space with drastic rate cuts. He's warning that Europe should be cautious about assuming inflation will stay dead. There are still plenty of tail risks that could rear their ugly heads and send prices spiking up the ladder again. So, if the ECB uses its limited ammo now with aggressive rate cuts, it might leave themselves without the tools they need when the next inflationary shock hits. And let's not even get started on the impact of Jeremy Clarkson, level political shock still brewing beneath the surface. Yeah, I went there. Aren't energy prices the real wild card here? When we talk about Europe's economic malaise, we cannot ignore the extreme price of energy, which might as well be considered the lead weight tied to Europe's feet as it treads water in the deep end of the economic pool. With the Ukraine conflict grinding on and global oil markets more volatile than a toddler after too much candy, Europe's energy woes aren't subsiding anytime soon. Here's the thing: energy costs hit everything. They trickle down from factories burning fuel to power machinery, to transportation that moves products, and then finally to the consumer who buys the end product for a much higher price. Major European exporters, insert emphasis on manufacturing giants like Germany here, are getting slammed. Don't companies act rationally? If energy is too expensive, they tend to scale back production, shed jobs, or at the very least hold off on investments for the foreseeable future. So, how does deeply cutting interest rates help here? Realistically, not much. Lower interest rates aren't going to alter global commodity prices. There needs to be more coordinated action that isn't just monetary policy magic. Real reforms, from energy sector modernization to clean energy investments, are needed to buffer Europe from being at the mercy of crude oil markets or gas prices that fluctuate faster than a heart monitor. Want to rein in energy costs, stabilize critical sectors, and give industry renewed confidence? Start with a strategic pivot in energy and fiscal policies. Already, Finland's Olli Rehn is hinting that the line between cyclical and structural factors remains blurry, pointing out that even longer-term investment decisions are still pinned down by the current financial conditions, which link back to monetary policy. Investment driven by aggregate demand can still be shaped by easier rates, he suggests. Sure, but only so far. Financial conditions can create fertile ground, but they won't plant or water the seeds. The role of fiscal policy is inescapable. Here's the real talk: monetary policy can't fix what fiscal policy breaks. Europe's governments have been in denial for years about what's really required to make their economies less like old jalopies sputtering along. They've been drumming the old broken record line: maybe next year we'll address structural reforms, just after we figure out how to patch up this immediate problem with more ECB pixie dust. But no. At some point, Europe needs to acknowledge that fiscal policy is the elephant in the room. Fiscal policy isn't a word people typically want thrown into their early morning coffee, but hang tight. Europe's golden sulking age on this front is what's been stifling any serious rebound. Countries like Germany, with their commitment to Schwarz Null, Black Zero, policies or balanced budgets, have been particularly reluctant to step in with fiscal stimulus, even when fiscal room exists. Instead of using government spending to counter the cyclical downturns or to facilitate the type of infrastructure investment needed to fix deep-rooted issues, austerity has become the mantra of choice. But look at France, the Eurozone's second-largest economy. Political chaos reigns as labor strikes and budgetary chaos send the country teetering. Does France need lower interest rates? No. It needs social reform, political stability, and a government willing to manage its public finances responsibly while addressing the inevitable need for strategic investments. You can't fix structural turmoil with a monetary policy band-aid. Fiscal policy alignment is crucial. Germany. Same story: get over the addiction to budget zealotry. A good fiscal stimulus targeted at public investment, not populist handouts, could give their creaking economy the push it needs to unlock corporate pent-up investment. The German industrial base doesn't need to be paid to borrow, financing isn't the issue, confidence is. So when Catherine Nice at PGM talks about needing a unified, coherent policy package, she's spot on. It's not enough for the ECB to get inflation and interest rates perfectly calibrated. The real juice has to come from governments actively crafting tax, infrastructure, and labor reform policies that complement loose monetary conditions. Think of it like this: cheap money is the gas, but effective government policies are the engine. One without the other and this car goes nowhere. Adding fuel to this already complicated economic case is a list of geopolitical risks that continue to loom like a black cloud over Europe. The Russia-Ukraine war, for instance, grinds on. As previously mentioned, this war has sent energy prices through the roof and triggered uncertainty throughout the continent. But it's also forced Europe into a longer-term rethink of how it can ever reduce its dependence on potentially hostile foreign powers. That's not something any amount of monetary policy can resolve. Then there's the growing specter of Donald Trump's return to the White House in the US, like a bad sequel that nobody wants but somehow gets made anyway. Trump's America First policies involved some aggressive tariffs that hurt European industries, especially their key exports, and these problems could come roaring back. The uncertainty over trade deals, tariffs, and more global fragmentation will make even the most optimistic corporate planner hesitate before greenlighting new capital projects. If Trumpian trade wars come back with a vengeance, growth forecasts for the Eurozone might need to be revised downward yet again. Trump only likes one thing more than a tariff war, well, two things actually: winning trade wars, and predictability, ain't it? Then there is China's slowing economy, which poses yet another headache for Europe. As China, the world's factory, transitions towards a domestic consumption model, purchases of European exports slow down. Even though Europe has been trying to reduce its reliance on China, Germany and other manufacturing giants have built half of their post-crisis recovery on demand from China. Given all this, Europe's long-standing policy of reluctance to take the dynamic of global trade into account could come back to bite them. Even closer to Europe's backyard, Middle Eastern tensions remain volatile, with oil supply disruptions or new wars in the region always capable of upsetting global energy markets. The Israel-Palestine conflict has re-erupted violently, and this has sent crude prices spiking temporarily just in the last few months. With this constant volatility in the air, how on earth is a rate cut supposed to help with appropriately calibrating investment in such unpredictable waters? So let's wrap it up. What really is the way forward for the ECB and, more importantly, for the Eurozone economy? First of all, everyone needs to get past this flawed notion that rate cuts are a magic bullet that will lift Europe out of its crisis like some economic fairy tale. Sure, there's a time and place for monetary policy adjustments, and ECB easing could provide temporary relief, especially if interest costs are choking corporate balance sheets. But anyone who thinks rate cuts alone will solve Europe's problems is chasing leprechauns and unicorns. The reality is this: Europe's troubles run deep and wide. They're rooted in structural problems, from aging demographics and insufficient productivity growth to fragmented labor markets and inefficient regulatory frameworks. No amount of interest rate cuts will resolve these. The best the ECB can do is provide some breathing room, lower borrowing costs to ease financial conditions, but in the end, governments must step up to the plate. The incessant reliance on the ECB pulling the region out of crisis every time politicians drag their feet is killing Europe's long-term viability. The future of the Eurozone depends on far more than just monetary policy. Solid fiscal reforms, coordinated investment in infrastructure, renewing supply chains, and addressing energy bottlenecks are key pillars that need to be constructed by the governments themselves. Until Europe accepts that you can't rely on a central bank to fuel an economy plagued by structural cancers, expect more debates and more disappointments in the council halls of Europe. Fabio Panetta might get his wish for more rate cuts to pump immediate life into the Eurozone's fading pulse, but unless fiscal policy reforms and structural adjustments go hand in hand, the long-term diagnosis remains the same: more muddling through, less growth, and yet another crisis waiting to pounce when they least expect it. That's your macroeconomic scoop for today, folks. Keep watching as Europe doubles down on short-term solutions to long-term disasters. Luckily for us, the ECB's rate adjustment show is always entertaining.